Hello to all traders and welcome back to another live engagement with the non-farm payrolls brought to you by myself, David Kinley, and this has been brought to you by Orbex. My special guest, Daniel, will be joining us shortly, but for now, just want to welcome you all. Thank you very much for joining me today. We've got the chat bar open as usual for those that want to obviously have a discussion as we go along on the non-farm payrolls and where we're going to be for the final non-farm payroll of the year as we head into 2024 already. What a year it has been. We've had quite a big move on the market for inflation, interest rate hikes. The Fed is still undecided where to go next, but with this next NFP report, will we have more of a pathway into that as well? So as I said, thank you very much for joining me. I'll get right onto the charts and like I said, I've got the chat open. If there's any markets you'd like me to check, we'll check the usual ones: gold, euro, dollar, etc. But we'll obviously, as we go on, we'll have probably a lot more to talk about, and especially as we are looking likely that it will be quite a good NFP for America as well. So let's just get right into the charts. But before we do, just have a quick risk disclaimer, because I just want you to know that this is based on my own account and it's for information purposes only. There's no information contained constitute or investment, and it shouldn't be the basis for any investment decision. Orbex Limited does not guarantee the accuracy or completeness of any information or analyst supply. So without further ado, let's get right into where we're looking at the moment. So the non-farm payrolls last time around 150,000, quite a lower number that we've seen in the last few trading sessions. But is that going to change this time around, and where will we be this time next year as well? With the Fed expected to start slowing down on its interest rate hikes, will this be a cause of concern for a lot of our traders? Will it be for the economy as well? Don't forget, we are looking likely that price action will start moving a bit lower on gold, especially after we've seen record highs. But enough about the charts at the moment. Let's just take a look at the presentation just quickly. So as I said, we're expecting an increase of 30,000 new jobs to be added, but it's only 180,000. So it is still a little bit subdued compared to where we've been last time around. And as you can see here, on the grand scheme of things, we've been just treading water around 200 to 300,000 new jobs being added every time. The last time around, though, it was placed at 150,000. So is this going to be a cause of concern for the American economy? Even if we get to 180,000 new jobs being added, is that going to be anything to cheer about as we run up to the holiday season in America? Unemployment is expected to move up to 3.9%. It was at 3.8% previously. So a couple of sessions ago, previously 3.9% still. So we're just close to that 4%, which isn't good for America. It was down to 3.4%, which was the lowest it's been this year, but it hasn't really had anything to be positive about since then. So just one last quick glimpse at this. So as I said, we've been hovering around 200 to 300,000, apart from the 165,000 that was added a few months ago. Since then, 297,000, then 150,000. So it's not looking likely that the economy is any better off this time around. But is the Fed going to have anything to do about that? Because it has cooled its inflation, so its interest rate hikes to 5.5%. And this is still at a 22-year high. However, the last couple of readings and meetings for the Federal Reserve has stated that they are not planning to have any further hikes in the near term. But there's still one more Federal Reserve interest rate decision meeting to have next week. So is this going to be a basis of what's to come for 2024? Rates are expected to stay higher for longer. There's not expected to be a terminal rate to be made at the moment, to be decided on. And also there's not expected to be any chance of rates being decreased as well. So that's quite worrying. They expected to stay higher for longer. And just take you through this annual inflation year on year of where we're looking at now. 9.1% we were at in July of 2023. Since then, 7.1, 6.5, slowly moving downwards. We got to 3%, and then we had a slight uptick, which worried the Fed quite significantly. Hence, we saw another rate hike in the summertime. But since then, 3.2% now. So can we get below 3%? And more importantly, get to 3.2%? This will be quite an achievement for the Fed if they can get to their target rate, because at the beginning of last year, they were saying they wanted to get down to 2%, but it hasn't happened. Where are we going to go from to next? And what does it mean for the market? So that's the presentation over and done with. We'll get right into the markets as well. Just need to share my window once again. So I'll just hide myself just for now. I'm still here, don't worry. Just wanted to show you the whole layout of my other screen. So we've got, euro dollar, Dow, cable, the loonie, gold as well. Let me know if there's any markets you want me to look at. Hi, Nikhil, welcome back. Always a favorite on our NFP channel. Want to look at gold? Gold is coming up. So keep your questions coming. Anything that you want to ask me, or anything that you're trading on that you just want to have a look at, maybe discuss before the NFP does happen, feel free to do so. So we have this record high of over 2100 for the first time ever, obviously because it's a record high. But since then, we had this over $150 move to the downside. But since then, we have picked up and we are consolidating nicely. So I mean, if you have been trading gold recently, you'd know how crazy it has been. And this move in the market was just pretty much, speculation. The Fed is going to stop raising rates. Obviously, we've still got the conflict going on in the Middle East. And, this seems to be ongoing for a while. But if we bring it to a daily chart, as you can see here, it is looking more likely that price action has just kind of seen a false break here to the upside of over possibly about $80 to $90. And since then, we've moved quite dramatically back down. So anyone trading gold and selling at the correct price would have made a nice tidy profit there, because it was very predictable that gold was not going to keep on moving higher forever. And as you can see, even on the 1 hour chart, look at this big false spike here. We have this move of $25 in just a quick flash before we started settling lower. So this was quite such a bullish move in a 1 hour chart from here up to the peak, $70. But if we look at the full body of the candle, $46 of a full body candle in 1 hour, it's just completely remarkable. So it was such a big test for a lot of gold traders, and also a big learning curve as well, because as I said, we didn't see this type of move in gold for a long, long time. Even when the Russia-Ukraine conflict began, even when COVID-19 hit, there wasn't such a surge like there was at the beginning of this week. So it has had a lot to be said about the yellow metal. Since then, though, let's take it a little bit more intraday, 30-minute chart now. As you can see here, very, very indecisive, choppy action here, very consolidative, moving. If we just move this up a little bit to where the full body candles are at the moment, just move this down a little bit. So we're trading roughly 2020 to 2037. Let's just give or take a $18 to $20 region here. Once we break out of this $80 to $20 region, then we'll get a very good idea of where gold is going to next. A lot of analysts and economists are saying that we are going to probably test 2050 again. 2000 is expected to become quite a support now for gold. So this is what we're looking at here at Orbex, and obviously a lot of traders that I've been talking to as well. So let me know what you think as well. If you're trading gold, it is very, very unpredictable at the moment. But since the consolidation has really kicked in at the moment, it's very, very undecisive. Buyers attracting buyers, sellers attracting sellers. It's looking likely that it will keep its run going for a little bit longer. Obviously, we could have a bit of a spike when the big fundamental news headlines hit, such as the NFP and the Federal Reserve interest rate decision. However, it is expected to continue its path a little bit more sideways. So tell me what you think, what you're trading on. As you can see here, there was a steady incline in gold throughout the last few months, and also the few weeks going back to the middle of November, since we saw it trading just at the mid 1900 area. But if you think about then, over $100 move to the upside is quite significant. So this is what we're looking at in the near term, at least. But very exciting times for gold. It's one of the most treasured assets that a lot of our clients and economists trade on. And obviously, when there's big fundamental news events in the world, we are looking likely that gold will be quite traded on as well. So Nikhil and all the viewers watching, I hope I gave you a good gold analysis. We'll move on to our next chart, which is the euro dollar. I've just had a few questions about that as well, where we're looking at the moment, because since we saw such a weak dollar, we hit the 110 area, but as you can see here, 250 pips to the downside, and this isn't a matter of months, this is just a few days at the end of November. So this was just roughly about this time last week. We've moved over 250 pips to the downside, so quite significantly we are looking likely that this bearish run will keep on pursuing. We did have a slight uptick, as you can see here on the 4-hour chart, roughly just over 50 pips, but then we had this V-shaped recovery to the downside. So if we just zoom in on the 1-hour chart here, we are just seeing where gold could be, the euro dollar could be going to in the near term. As I said, this move to the upside here has been wiped out considerably, just over 50 pips, like I said. We're just now trading to the downside, and we're just waiting to see if we can pierce and crack this bottom of the mid 107 area. This will be quite significant as well. So very exciting times for the market, because when we see a weak dollar, obviously we see a strong gold sense as well. And not only gold, we've seen silver flying quite dramatically as well, going over $24, but we'll check that out shortly. At the moment though, it has been quite progressive for the dollar against the euro, with the price action going lower, but it's completely wiped out this particular move to the upside for the euro. This has happened in the last couple of trading sessions. So let me know what you think, because on the pound dollar, what's interestingly enough is when we see the euro dollar and the pound dollar, I'll just put these two charts side to side because they usually move in tandem most of the time, but this time around they haven't really had too much of a movement. Yeah, as you can see here on the 4-hour chart, euro dollar has really progressively moved lower, 250 pips. Pound dollar though, we've seen it's quite still a move in the pip value, but it has been very choppy in that sense. It's moved from the last swing high only 160 pips. So this is something that we're looking at the moment, because usually they move in tandem, especially when the dollar is a little bit shaky, and it's looking likely that price action will follow suit as well. So this is what we're looking at the moment. So just over 15 minutes until the NFP is going to be announced. As I said, my special guest Daniel should be joining us shortly, but I'll take you through more of the charts as we move through them. So the Dow is another chart that I just want to have a look at as well, because on the daily chart, this is quite significant, because we've had this move to the downside, then we had this V-shaped recovery, but unlike the S&P 500, as you can see here, we are having a break of this particular area here. Let me just bring out the S&P quickly. Because I just want to show you side by side what we're looking at the moment. And I'm just finding it all at the moment, which will be helpful. So since then, we're just looking at the Dow. I'll go onto the S&P shortly because Daniel is just waiting to join me at the moment. So I'll just quickly look at the Dow just one more time. Hi, Daniel, can you hear me? I think your microphone is off. I can't hear you very well.
Right. How about now?
Yes, I can hear you now. Great.
I always forget to pull that down.
How's it going? You okay?
Yeah, a little bit tired, but doing good. How about you?
Yeah, great, thanks. So I was just telling our viewers what a dramatic. I mean, there's probably only one of the big stories in the asset market at the moment. That was gold this week. That's just been jumping and flying. And then
Yeah.
really going back to kind of restoring itself, let's say. I mean, it was a little bit of a false break to the upside, you could say, and buyers attracting more buyers, because since the big spike on Monday, we saw over $150 wiped out. So is this just one of those phenomenons that we get every now and again? But, this time around, gold's hit record highs. It hasn't just hit another high.
Yeah, it really went high above before closing further down. So it's like a Mount Everest kind of spike there, really high and really fast back down. But it seems to be kind of like more. It happened over the weekend, so I guess people were sort of positioning ahead of risk events that were coming. So it's probably more like technical nature than sort of a just major fundamental shift than anything.
Yeah.
So, but I mean, I think it was, what was it, 2 months, two NFPs before ago that we were talking about the gold having all these set up to keep moving higher.
Yes.
So it might have
Yes.
been like just a brief preview, and then coming back down to earth, and then going back and then returning to the general trend. So I think it's kind of like a trailer, shall we call it? How you have a movie and they go in and put a little bit of trailer first. Maybe that would be something like that.
Exactly. So, I mean, were you surprised on how quickly such a big spike could happen, and then such a deterioration of the value of the asset can happen in just like one trading session?
Yeah, especially for something that's generally so stable as gold. Like
Yeah.
kind of the selling point of gold is it's stable, and suddenly it goes this large spike that's a little bit reminiscent of Bitcoin. But uh,
Yeah.
I think it's sort of like one of the things that happened. It also happened over the month end closing. So you had a bunch of contract expiries that are happening the day before, and so then you can have those larger moves when you have less volume, and then of course there you have the geopolitical factors that are going on as well, and so
Yeah.
it is surprising, of course, to have the large move, but then after the fact, you can then sort of like see what the factors were and say, oh, it kind of sort of makes sense that you had this large spike close to the close on a Friday, and then on Monday you get more of the return to normal and correction. So people didn't want to take very much risk over that weekend.
Exactly. Yeah. I mean, that's the thing with the weekend news, isn't it? When there's a lot of speculation, there could be big market gaps on the opening, but this was just such a big phenomenon, and it happened on the early Asian Australian session as well. So,
Yeah.
um, I guess by the time maybe Europe and America woke up, it kind of lost its big phenomenon, and then obviously the sell off began.
Yeah, it's sort of like, hey, gold is up really high. Let's sell and then push it right back
Yeah,
down.
exactly. Yeah, exactly.
Yeah,
uh,
there's also always like there's this constant risk going around because of the United States yields that you have with the treasuries, and there's always the concern that you might suddenly have a problem with one of the auctions going through that might
mhm.
push yields up, and then of course if the yields go back up on the treasuries, that inversely has an effect on gold, because the gold doesn't pay any yield, and so then if the yields in the treasuries go up, you could end up having gold fluctuate around. So there's always that um, kind of extra risk going into the weekend for gold right now, not necessarily because of gold, but more because of the situation with the United States having so much debt, having to
Yeah.
service so much debt, having to issue so much debt, and also issuing it in such short term that there's a more of a risk of a spiking in the yields, or a trip downwards, but it's more a risk to the upside. Of course, that also affects the dollar. That if the yields on the dollar on US debt goes up, then you would generally see a dollar move higher. So that's kind of like you had a bit of inversion. You had the yields were sort of trending down through the week, but also the uh, the dollar wasn't really gaining all that much because
Mhm.
people are still sort of like, I guess they're getting into a bit of the year end. Let's not be exposed to too much risk right now. You have like next week, there's
Yeah, there is
a
that as
huge
well.
pile of risk coming up. So I think
Yeah.
it's also,
I was just going to ask you as well, as the final Fed interest rate decision comes. I mean, we've had quite a bit of a drop back down to 3% year on year for the inflation levels. The Fed
yeah,
is targeting 2%.
yeah.
Obviously, it's not going to get there this year, but it has had quite a progressive journey throughout the last couple of years to get it down to where it is now. So with that being said, if the Fed does see a slight uptick in inflation, could it just straight away say, okay, we're going to hike again at least 25 basis points?
That's this probably because I think the Fed is really worried about having that rebound in inflation
Yeah,
because it goes to the credibility issue. You know, you had the Bank of Canada and also you had the RBA. They both tried to do the pause, and then following that, they had inflation go up, and so then they had to raise rates, go
yeah.
back to raising rates, and their pause. And so the Fed is probably extra worried about that because they saw the experience of the other central banks that tried it. And also, the Fed has this kind of reputation of going in one direction, reaching their point, and then going in the other direction. You know, so like you don't have this thing where the Fed raises and then sees where things are going to be going, and then
Yeah.
raises. It's sort of like the Fed kind of sets the tone, and so they
Hmm.
would probably be a lot more like if there's still a risk of inflation popping back up, that might be why the Fed, everyone's sort of like expecting the Fed to come up in the next, at least the next meeting, say, hey, you know what, we're done with the hiking. We're gonna pause now. The Fed
Hmm.
probably isn't going to be as likely to do that, at least in my personal estimation, because mostly because they want to keep that thing going where they don't have to change course. If they go and say, well, we're going to pause now, and then you see core inflation go up to 4.2, 4.3,
Yeah.
and then they might suddenly say, yeah, now we have to raise rates again. And then that would make them really uncomfortable. So it'd be a lot easier for them to say, yeah, there's still a good chance we might raise rates, but we're going to pause again. And then we're going to pause again. And then we're going to pause again.
Yeah.
Each time saying, well, we might raise rates. And then eventually it's going to come to the point that they have to cut,
Yeah.
because it kind
Yeah.
of sort of happened last time. Was it 2018? It was that they were on the rate hiking cycle, and then there's some issues with the financial markets, and they were forced to cut. But they did go through that pause thing, talking about continuing to raise until they cut, and then it sort of changed. So I would imagine something similar would happen, assuming there is no major recession, which is still the thing that we're still waiting pending on.
Well, yeah, there is. I
But
mean, we are expecting a soft landing now as we
yeah,
approach the end of the year. But like you said, there is this dark cloud of recession still hanging over the American economy. But with that being said, with the inflation rates and everything, interest rate hikes, they're still expected to stay higher for longer. We haven't really had any word of a terminal rate, and we
yeah,
haven't really heard any confirmation that there will be any decreases in
yeah,
the rate. So it's just kind of like, okay, we're just going to keep moving along, and maybe as we go into the middle of the year, we'll see how it goes. I mean, it could probably last until this time next year, couldn't it, before we get any word of
yeah, exactly.
any
I mean,
decreases?
yeah, according to the Fed, like in their model, what they would like to see is, keep rates going at the current level, or maybe a couple, interest rate, 25, 50 or higher, but keep it steady through the rest of the year. That's their ideal situation. But then, of course, you have the reality, and the market is already saying we don't believe the Fed is going to keep it. The Fed, I mean, the market has been predicting that the Fed wouldn't go as high as it did, and then
Yeah,
that didn't work out. And so it's kind of like, are you going to believe the market, or are you going to believe the Fed when it comes to what the Fed is going to do?
exactly. Yes, yes.
Kind of thing.
But
So
it's yeah.
yeah.
Sorry. No, I was just
Oh,
going to
so
say it's got to the point where we don't. I think some members of the Federal Reserve are wondering what the Fed is going to do.
yeah, it's also, it's kind of a little bit of uncharted territory, even for the Fed, because the last time you had such a large move in inflation was like in the 80s, in the early 80s.
Yeah, yeah,
None of the people that were working the Fed now were working back then.
yeah.
And in fact,
True.
I don't think I was even born then, or maybe I was born right around that time exactly. So
Yeah.
yeah, I don't remember how that was. So it's still kind of hard to remember, to predict that thing going back. But also the other thing is that if we go back to the prior recession, the subprime one, it was like a rolling thing that happened over 2 years. So you had 2007, you had the market went down, and then it sort of recovered, and everyone said, "Oh, it's over. We're coming into an election year. You won't have a recession." And then it went down again in 2008. So
Mhm.
we had one year where the market went down, and then at the end of the year it came back up again. And so you
Yeah.
might have that repeat thing happen again. So but then of course, past performance doesn't equal future results. So then you can go on to do something completely different. But there's a couple of patterns going around there that kind of suggest that we're not really out of the woods yet. But that's the thing. Everyone all before last at the beginning of this year, everyone was agreeing that there's a recession coming. Didn't happen. Now
Yes.
everyone's kind of agreeing there isn't a recession going to happen, and so it's like, generally speaking, recessions happen when the consensus is there isn't a recession coming.
Yeah, when it's least expected. And like you said, history does have a way of repeating itself. So,
True.
I mean, a lot of traders and economists alike, and even our viewers watching now, they should have an interest in, if there is speculation in the air, it means that it could happen at any moment. And obviously, with recessions that have happened, global recession, housing recession, all these other things that have been happening, it could happen at any moment.
Yeah, exactly. There was a thing that I forgot to mention along the way, but oh yeah, it was the yield curve inversion, which has been accurate since like the 1960s,
Mhm.
and everyone says, well, the yield curve inverts, then you get the recession. But what also
Yes,
happens is that it de-inverts a couple months before the recession actually hits, and so far it hasn't de-inverted. So it make the as far as the patterns of the past go for the yield curve inversion, is still on track. So that's another factor to keep in mind.
exactly. Yes. Well, yeah. I mean, it is something to keep in mind as well. Especially, we've had the pandemic. We're just getting out the back of that. Obviously, the Russia-Ukraine conflict, and now the Middle
Yep.
Eastern conflict. I mean, it is a domino effect that it could affect globally. Trade, fuel, oil, gas, all these things that are coming into a big, a spider web, let's say, altogether. So it could have a knock-on effect. And obviously, we've seen that as well on such a big spike on gold in the last couple of days. This might not be the last big spike that we see before the end of the year.
Yeah, especially as we're going into after this week, you get a significant reduction in volatility. Well, not volatility, in liquidity. And so when you have fewer traders and fewer money chasing the trades, you are more prone to have sort of these large moves that come out of nowhere and then they fade relatively quickly. So that's why it's a little bit. You have better opportunities to get a bigger move when you're trading at the end of the year, but also you have an increased risk. So it's something to keep in mind. Particularly keep your stop losses, keep good in mind, exactly to make sure you don't get blown out by any of these large unexpected moves. And
Yeah,
especially with all the geopolitics that's going on now, you have this increasing tension in, well, like the Israeli Palestinian conflict. It came out of nowhere, essentially. Like on
exactly.
October 6th, everyone was like, no one was expecting a conflict to happen there, and
Yes.
so we don't know where the next one is going to be.
Yeah. So just over 1 minute to go before the NFP. I just want to quickly touch on, just 30 seconds to pick your brain in there, Daniel. Unemployment is at 3.9%. So it's a little bit awkwardly high. We did drop to roughly about 3.4%, which was the best reading of the year, but 3.9 heading to 4%. Is it a bit worrying?
Oh, well, it's getting back to the sort of structural level. I don't know exactly when the Fed was say that they're getting worried about it. It's more the seems like the bigger worry is the jobless claims, where
Yeah.
the number of people that are seeking unemployment benefits, that keeps going up constantly,
Yes.
and so that seems to be more of the concern than the rate itself, because also you have this issue with the very low participation rate, which
Mhm.
is the number of people as a percentage of the population that are working is still below what it was pre-pandemic, and so
That's
that could
true.
be
Yeah.
keeping the inflation rate artificially low, because it might be
Mhm.
like, if there's a for some reason a lot of people feel like they don't need the money, so they're not going back to work, at
Yeah.
least formally or officially, and so it's something might happen that will cause people to go back, start looking for jobs, and that would suddenly could push the unemployment rate significantly higher. So it's kind of a risk situation, because also we have that issue with the large number of job openings that have been going on up until quite recently. Now it seems to return to back to normal, so we might
Mhm.
see another distortion happen, maybe in this month, maybe within December. But then of course we have well, here it comes, so I should shut up.
Oh no, it's fine. I was just going to say we're just going to see what the numbers are at the moment. So Non-farm payrolls just coming in now. So, just under 200,000. So 199,000 new jobs. Consensus was 180,000. So we are not bad. Unemployment rates dropped to 3.7% as well. So
Oh, yeah, in the
we
other
should
direction.
see quite a progressive dollar in the next couple of minutes,
Yeah.
just to see if it's going to have a move the other way. But obviously, when we do get positive NFP numbers, they could last the whole session, or we could just get a bit of a slight move before retracement. So we'll just see how much they're going to move. We had one person, Camel, he's asking about pound dollar. We'll just put that on for a quick look. So pound dollar is actually dropping quite significantly. Obviously, everything moving in the favor of the dollar. 50 pips to the downside now, looking at 125.15. So probably a nice support there. Could be around 125 psychological area, but we'll see how much that's going to drop as well. So yeah, dropping across the board at the moment. In favor of the dollar at least. Gold as well, just moving down just at $3 or $4, not too much to shout about there. So what are your first thoughts, Daniel? Just looking at participation rate, just roughly about the same as previous, and the average hourly earnings roughly about the same year on year as well. So not a bad NFP number this time around.
Yeah, it's close to where you would expect a good normal NFP to be. Of course, you always had the issue that the prior ones tend to be revised lower. But I think what the people are probably going to be pricing in a higher chance that the Fed is just going to not say that they're going to do any kind of pause at the next meeting, because the Fed is now worried more about the labor costs that are pushing up inflation.
Yeah.
So when you have the average hourly earnings going up at 0.4% as opposed to 0.2% that was last month, if you extrapolate 0.4% out to 12 months, assuming that comes out to be 4.8%, which is not good. At 2.2%, it's 2.4%. You can get a little variation, and now that's kind of close in the ballpark of the 2% target. But 0.4% is 4.8. That's above the current core rate, so that's probably where you get a bigger reaction from, I would expect. But it might fade if we get some of the components. But really, it's probably going to come down to the average hourly earnings, and then whether that's going to be supported with next Tuesday's CPI. If inflation comes up a little bit more above expected, then there's still a possibility that the Fed might hike. Like I
was just about to say, I mean, we're not out of the woods yet with big fundamental news events and obviously big surprises, but we've got one more potential hike before the end of the year. I guess after that, as we get into the holiday season in America, do things generally calm down, or will you possibly see a bit of a Santa rally or anything to worry about before the end of the year as we go into the last couple of weeks?
Well, it seems like pretty much everyone's going to wait till the ECB is the last of the big ones next week. And then after that, it's going to be like, let's go on vacation. So then that's when you usually start getting the Santa rally, because you get sort of more smaller traders, retail traders, who can tend to be a little bit more optimistic. And so historically speaking, there's supposed to be a Santa rally coming up. But you had that big move back in November, so a lot of people think that maybe there'll be a fading, or the Santa rally might not be as strong going in. But of course, the Santa rally is going to be a little bit detrimental to the dollar, because it's kind of a risk-on event. But with the latest, I guess it's going to really depend on what the Fed says. If the Fed just ignores the data and keeps going with their current trend, then the market might go back to being a little bit more optimistic. But if the Fed keeps to their hiking agenda, then maybe you won't get a Santa rally, because they'll be worried that they're going to be higher rates.
Of course, that is true. So Daniel, before you go, I just want to ask you, since we're in the last few weeks of the year, and obviously this is the last NFP of the year, where will you be looking at in the early quarter of next year? Any markets or assets, instruments that you're looking at? Just like taking a back seat, not really, not like gold and silver, these kind of
Oh yeah.
predictable things. So is there anything you would
I was going to say gold.
Yeah. We could end the interview there, then, I guess. Is there anything like, just little diamonds in the rough that you can probably pick out just to have a look at for probably the first quarter of next year?
Oh, you had the thing that happened in Argentina, which might shake up the commodity markets a little bit. And then, of course, probably not necessarily, China isn't like a small thing, but you would be kind of interesting to look at how China's recovery is going, particularly for the Aussie because of the iron ore prices. They've been a little bit shaky, and then we have this thing going on with crude, which most people sort of think, oh, crude, that must be the Canadian dollar. But the Canadian dollar is kind of affected by what's going on with the Fed. So here, if we have the Fed pushing the rates higher because the American economy is doing good, but the BOC isn't, you might not actually see so much of a move in the Canadian dollar, but it could have a bigger effect on the euro and on the pound, especially if the prices go down, because Europe and Britain are importing a lot more, and they're now importing it from other countries, and they're also importing it directly from the United States. And so more of that natural gas and crude oil export capacity is going to be coming online soon. So that might mean more selling pounds to get dollars, more selling euros to get dollars. So that could put the dollar basket a little bit higher. And it might, the euro isn't sort of like something that isn't pretty well known, but everyone trades the euro, kinda. But that might be one factor to sort of like keep in mind, particularly as Europe is kind of heading into sort of something of stagnation to recession, technical recession.
Yeah, you
kind
could
of
say
thing.
that, yes.
Yeah.
I was going to just ask you one final question.
Of course.
The odds of a recession for next year, is it still there, but it's less likely now?
Yeah, I would traditionally say, it's an election year, and usually you don't have a recession because the government puts out so much money. But then, of course, last time the great financial crisis happened in an election year, so then there are exceptions to the rule.
Of course.
So it's not as likely, but I was originally sort of thinking if it was going to happen this year, it'd probably be September, October, and it might be postponed a little bit because of how much money the United States government is spending. A large, like if you go through the portion of the non-farm payrolls, what you'll notice is that they've been increasing, but it's mostly government jobs that are growing, and in this current one, the non-farm private payrolls were below expectations, even though the total number was significantly above expectations. It's because a portion government payrolls were 19,000 above expectations. So the government is spending a lot of money, hiring a lot of people. That's sort of keeping the economy going, but it's not organic economic growth. So it is reflected in the GDP, but for the people that are out buying and going about their daily lives, it doesn't feel like the economy is doing so well. So they're not going to make a decision based on what's being reported in the news as the GDP number. They're going to make a decision based on how much money they actually have in their pocket. So that could be sort of like the surprise or the black swan that's floating around there. But of course, you can't really say what the surprise is going to be, because then it wouldn't be a surprise. So
of course.
wait around for the surprise. There's going to be a surprise. Can't tell you what it is because I don't know what it is.
Exactly. Okay, Dave, that's great. Well, thanks for your insight once again on this NFP. And
thanks for the invitation.
No problem at all. And for the final time this year, thank you for joining me and us. And we'll catch you in the new year for the next NFP.
Well, yeah, have a happy holidays, a great new year and all that, and happy trading, and hopefully everyone gets a new start for a good year of trading.
Exactly. All right, Daniel. Well, thanks a lot once again, and we'll catch you next time around.
All right, take care.
Take care. Bye for now. Bye.
Bye.
Okay, so that was Daniel. Thanks again for him to join us. And let's just take a look at what the markets are showing us at the moment. So euro dollar, we're just seeing now a slight retracement, a little bit like cable as well. We saw a move of just over 50 pips, as I said, exactly like cable. Retraced halfway pretty much since then, so roughly 25 to 30 pip retracement, but quite a progressive move on the dollar, especially the fact that I'll just hide my camera so that you can see the whole screen. Yeah, so we're just seeing now that with a slight retracement, but still in this bearish run for euro dollar, not really getting any let up at the moment. As you can see here, over 260 pips to the downside, almost 300 from the NFP. However, we're not looking likely that this will hold. When we start retracing from a big fundamental news event such as the NFP, it usually means that price action will start moving a little bit higher. But obviously keep an eye out for that as well. So let's just run you through the main markets that we were looking at. We had Kamal looking at gold, pound dollar, sorry. Again, much like the euro dollar, we had a spike of over 50 pips. But since then, we are now retracing nicely, and this is looking like a firm support at the last couple of swing lows. So hitting a bit of a triple bottom at the moment if we take out this false break here. Trading roughly around the 125.50 area, which is actually what I said earlier was going to be a pretty much a support area. So let me see by the end of today's trading session if that breaks again and we start moving towards the lower regions of 125. Unlikely, but we could do. So let's just keep an eye on that. Dollar Canadian, we didn't really look too much into it, but it hasn't really been too much of a mover because we didn't have Canadian dollar news as well. Just a bit of a small spike, now retracing almost like a full doji, retracing back to where it was in the beginning as well. Dollar yen, again, we didn't really have too much time to have a look on it. However, again, not too much to shout about because we saw a spike to the upside. Let's just see how many pips we got to, roughly about 80 pips. But since then, as you can see, full retracement. So this is something that we're looking at the moment as well, to have a full doji. And just want to look on the Dow, because the Dow, as I said, it completed this V-shaped recovery. I'll go to the daily chart so you can see it better. And we broke above that, and now we're consolidating nicely above, just above the 36,000 area. So if we go back onto the 1 hour chart, what we're seeing now on the Dow is the fact that we could have this kind of symmetrical triangle, or no, it's more like a bearish channel. And we're just going to be seeing if that's going to have more of a momentum to the downside. So holding that 36,000 handle quite significantly, which is quite optimistic for that as well. And finally on gold, our last market. So we're just seeing now how many pips, how many dollars we've moved in during the NFP. So moved just over $12, but since then, let's just zoom in a bit better. We have retraced pretty much half of that, so just over $5. We were at 2027 before the NFP, now at 2023. Excuse me. So we are seeing pretty much quite a big move there as well, back up to full retracement. Sorry. So even though we have had quite a positive jobs number, we are seeing full retracements across the board, even gold as well, settling back to roughly about 2030 as well. So any questions, keep them coming. I'll be online for a little bit longer, so feel free to ask any questions that you may have. But for now, it's thank you for joining me. It's been a real pleasure to take you through the whole year of the NFP engagements. Every single NFP announcement has been very, very exciting, very unpredictable, and obviously with your viewership obviously coming on board, asking me questions, keeping the NFP very, very interesting. Kamal, thank you too for joining me. And we'll see you next time around. So have a very productive rest of the year. I hope that you are trading responsibly. Any questions that you have, please feel free to contact us at Orbex. We'll be glad to ask any questions. I'm always available. You can find me on my LinkedIn account as well, and you'll be able to ask me any questions, connect with me there. There's obviously no pressure. It's just a one-to-one or any questions that you may have. And until next year, have a very safe rest of the year. And obviously, all the best in your trading, in your personal endeavors, and make sure that you trade responsibly. I can't emphasize that enough because we do care about our traders here at Orbex as well. So as I said, I'll stay online for a little bit longer. Thank you very much for joining me, and I'll catch you at the next one. Bye for now.